Let's take a look at Western Asset, and this is a REIT. And first we need the market cap, 156.5 million. And next we need the stock price, 293. And now we know the shares outstanding, because that's just the market cap divided by the stock price gives you shares outstanding, 53 million. So the way we're going to calculate the intrinsic stock price is we're going to estimate the future free cash flows of the company, then discount those numbers back to today's value. Then that gives you the value of the entire company, and we'll divide that number by 53 million, and that'll give us the intrinsic stock price. And then we'll compare it to the actual stock price to see if it's a buy or a sell. So let's get the actual free cash flows. And free cash flows are the cash that's left over after operating your business. So if you have positive free cash flow, then you're adding cash to the business and adding value to your investors. And if you have negative free cash flow, like they did in 2019, then you're going into debt to fund your business. So if you see a company with negative free cash flow year after year, that could be a sign of a big problem. Or it could be a sign they're trying to grow and they're constantly reinvesting into the business. We put the net income in also to the model. That's the profit and loss. And then we're going to put in the revenue, which is the sales. And those two numbers come from the income statement. Now we need to look at the capital structure of the company to figure out the discount rate we need to apply to the future cash flows. So they pay $150 million on their debt, and they have debt of $4.5 billion. I pulled that off of the 10K because Yahoo doesn't break it down, so we can't see how much debt they have. But they pay 3.34% interest on the debt, and they don't pay taxes because they're a REIT, so the cost of the debt is to 3.3%. And you can see 97% of the capital structure is debt. That's extremely high and a little concerning. Now let's find out the cost of equity. We need the beta, that's the volatility of the stock. And it's 1.63 is the cost of equity. So to figure out the cost of equity, we use the CAPM model, capital asset pricing model, and it comes out to 15%. But they're mostly debt, so the weighted average cost of capital, the discount rate, is going to be mainly the debt, the 3.34% debt, because the WACC is a blend of debt and equity. So we're going to use that 3.73% and discount the future free cash flows. And we calculated 4 years of free cash flow, and then we did a terminal value, which is all years past year 4. And the reason the terminal value is so low, you would think it would be higher than the previous year because it's taking into all years into account, because the model takes into account debt. So if a company has a lot of debt, they lose a lot on the terminal value. And I also built into the model a REIT if the company is a REIT, or if the company has a small market cap, it also alters the terminal value based off of that. And it's really difficult valuing a REIT, and I think I'm getting better at it because my numbers are getting closer to what they're trading at, but it's still really tricky. So we discounted the free cash flows back to today's dollar amount, and then we get a present value of those numbers, which is $100 million, and that's the value of the company according to our model. And then what we do is we divide that 106 million by 53 million shares, and we get an intrinsic stock price of $1.99. And it's trading at $2.93, so it's trading at a 47% premium. So we consider this a sell. So you can see this company was trading at about $10 a few months ago, and it's trading at that rate for a long time. And it's dropped quite a lot once coronavirus hit, and it hasn't really come back up much at all. So people are obviously not willing to pay the $10 they were a few months ago. The market is dictating a price of $3. So I'll leave it up to you to decide if you want to invest in this company. Most people do invest in REITs not for the capital appreciation of the stock. They invest in REITs for the dividend payments. But if the stock goes away, goes to zero, you don't get any dividend payments. So that's something also to think about. So let's look at their ratios to get more color on the company. And I input their current assets, current liabilities, and equity because it's not in Yahoo Finance. I had to go to the 10K. And the first ratio we're going to look at is the PE ratio, the price over earnings ratio. And this is probably the most common ratio. And this is the stock price over the earnings per share. And generally you want a lower PE. That means that the stock is a good buy if it's a low PE. If it's a high PE, that may mean the stock is overvalued. Because a PE of 2.2 means investors are willing to pay $2.20 for $1 profit. So it's a pretty good return based off of the PE. They also have a good price to sales. I like to look for under 2.2. Theirs is 1.7. That's just the stock price over the sales per share. So they're using their revenue efficiently because they do have a really good price over sales ratio. Price over book, generally you would look, if it's under 1, it's a great value, and this is under 1, so it doesn't imply it's a great value. That's the stock price over the book value, and the book value is your equity. And equity is total assets minus total liabilities. So according to the balance sheet, the company is a great value because the stock price is priced below what the balance sheet is. That means if the company ended today and you sold all the assets and you used that money to pay off the debt, you would have, that's the money you would have left over, and the stock price is trading below that. So if you liquidated the company, you would have enough money to compensate all your shareholders, which is usually not the case. But you have to look at the assets to really understand if it's a good value or not. The current ratio, they have a really good current ratio, 1.12. That's current assets over current liabilities. That's how companies pay their current operations, all the kind of the bills that are due within 12 months, the day-to-day process. So that looks pretty good. The ROE is 13%. I like to see above 20. That's your net income over equity. And this can be also altered a lot based on the type of assets you have. So let's compare these ratios to other REITs. So these are all the REITs that I have worked on since I started this channel. So the more companies I do, the more information I can provide. And I've done a lot of REITs, as you can tell. So there's 6 REITs. And WMC is right here. And I'm comparing the ratios for all those companies. And then the winner, which has the best ratio for that category. So the PE ratio, you want a low PE ratio. And WMC is really good, but MFA is 2.0. And you can see they're all over the place. BHR is 307. You really have to look at the financials to really understand it better, because it is challenging to value a REIT. The price of sales, you also want lower. BHR has a really low price of sales. WMC also is good in that category. Let's see, the price to book, MFA and WMC are below 1, and BHR, which is pretty amazing. You don't really see below 1 price to book ratio too often. Maybe it's more common with REITs, but you're definitely not going to see that with a company like Apple or one of those bigger companies. And the current ratio, it looks like a couple of businesses are in bad shape. AMT and BHR don't have enough cash to fund their business, so they're going to have to go into further debt. The other companies have an appropriate current ratio. Although Store has you don't want such a high current ratio because that just means you're sitting on a lot of cash and assets, and you should be using that money more wisely because we don't invest in companies so they just sit on cash. We invest in them so they run a healthy business and provide a profit. In ROE, like BHR doesn't have any income, so they have a 0% ROE because the formula is income over equity. So, and debt, WMC is actually the loser because it should be the minimum debt is the winner. So that's really concerning, 96% debt. So maybe it's okay for a REIT because obviously you can see there's 3 REITs that are over 90% debt in a capital structure. But you have also others that are fairly low. So that's a big red flag when investing in a company. So it's definitely something to keep in mind. But let me know in the comments what you think of this analysis, if you want me to talk about other ratios or if there's something you think you could shed more light on. Thanks for watching.